Welcome. Today, we're basically putting on our detective hats. We're going to solve a financial mystery. What happens when a company's books just don't add up? And how do accountants actually hunt down the culprit?
So, what does happen when the numbers don't add up? It's that sinking feeling, right? You've recorded everything, you've checked your work twice, but something is definitely off. Well, that's the exact moment our investigation begins. It's the first sign of a hidden problem that could mess with some really big business decisions.
And the scene of the crime? 9 times out of 10, it's right here, the trial balance. You can think of this as the master checklist in accounting. Its whole job is to prove one simple fundamental rule. Debits and credits have to be equal. Basically, it's just confirming that all the money is accounted for, where it came from, and where it went.
Okay, so here's the problem in action. On the left, everything's in perfect harmony. Debits equal credits. That is what you want to see. But look at the right. There's a glaring imbalance. The two totals just don't match up. This is the alarm bell, the first piece of hard evidence telling you an error is hiding somewhere in the books.
But here's the thing, not all errors are that obvious. Our first category of culprits are what I call the stealthy ones. These are like an inside job. They are incredibly tricky to catch because they don't set off that initial alarm. And here's why they're so sneaky. These errors are technically balanced. The debit and credit sides still match perfectly, so when you look at the trial balance, everything seems fine. But underneath that shiny surface of correctness, there's a pretty big mistake hiding in plain sight. For instance, an error of omission. Maybe you paid a supplier but just flat out forgot to record it anywhere. Or an error of commission. You correctly paid Smith & Company, but you accidentally logged it under Smith & Jones. Then there's the error of principal, like buying a new computer, which is an asset, but recording it as just another office expense. In all of these cases, the books look balanced, but they're factually wrong, and that can lead to some seriously flawed financial reports.
Okay, now for the other side of the coin, the errors that are, well, a lot less subtle. These are the smoking gun clues that scream to our accountant detective that something is very wrong. So unlike their stealthy cousins, these mistakes break the golden rule of accounting. They directly cause the total debits and credits to be unequal, creating that obvious imbalance we saw a minute ago. This kind of problem is pretty much impossible to ignore. It immediately makes you question the reliability of the entire set of books. We're talking about things like recording the debit for a sale, but completely forgetting the credit part. Or, entering a debit for $1,000, but accidentally typing in a credit for only $100. It could even be a simple math mistake when you're adding up a column. These are the kinds of errors that leave clear fingerprints all over the crime scene.
So, when you find one of these alarming errors, how do you even begin to fix it? Well, accountants have a secret weapon, and it's called the Suspense Account. I know, sounds dramatic, but it's an incredibly clever and useful tool.
Now, this is the absolute key thing to understand. The suspense account is not another mistake. It's just a temporary holding place. Think of it as a tool that lets the accountant quarantine the issue so they can keep working while they investigate what really went wrong.
So here's how it works. Let's say the difference is $500. First, that exact amount gets parked in this temporary suspense account. That little move forces the books to balance, which is super important because business can't just grind to a halt. Then, the real detective work starts to find that original $500 error. Once it's found and corrected, the suspense account is emptied out. And just like that, case closed. And that is the ultimate goal, a zero balance in the suspense account. That's the sign of a successful investigation. It means every single penny of that original discrepancy has been found, accounted for, and put right. It's the moment our detective can finally say, the case is solved.
So let's bring all these clues together. Cracking the case, whether we're talking about a stealthy error or an alarming one, is all about protecting the integrity of a company's financial story.
As you can see, the two types of errors give us totally different challenges. The stealthy ones, they keep the books balanced, so you can only really catch them through a super careful review or an audit. The alarming errors, on the other hand, they throw the books out of balance, and that very imbalance becomes the first and most obvious clue that leads you to the source of the problem.
At the end of the day, this whole process isn't about pointing fingers or finding someone to blame. It's a logical, necessary procedure that's all about upholding financial truth. This systematic work is what allows investors and lenders and managers to actually trust the numbers they're using to make really critical decisions.
Which kind of leaves us with one last thought to chew on. When you realize how much meticulous investigation it takes to find just one error,
Well, it really highlights the huge amount of unseen work that goes into making sure financial statements are actually correct. And it also suggests that having a healthy bit of skepticism for any set of numbers that seems just a little too perfect is probably a very smart idea.